If you've been investing for, say, 5 minutes or even 5 decades, you know the biggest problem is just the noise, information overload.
Oh, absolutely.
Every brochure, every headline, it just throws a wall of jargon and numbers at you. So our mission today is to cut right through that. We're going to give you a powerful 5-point checklist to evaluate pretty much any investment.
Exactly. We've synthesized the research into, well, a really rigorous framework. We call it FLIRR. It's an acronym that stands for fees, liquidity, imposition or taxation rendement, or return, and risque, which is risk.
Okay, so FLIRR. We'll stick to the English names today, I think. Fees, liquidity, taxation, return, and risk.
Right. It's just a systematic way to make sure you look past the flashy marketing and really focus on what matters.
All right, let's jump in. And just a quick reminder for everyone listening, this deep dive is purely for educational purposes. We're sharing insights and inspiration, not, personal financial advice.
Yeah, that's key. Your choices have to match your own research, your own goals, and of course your comfort with risk. Past performance never guarantees future results.
Okay, let's get into it. Fees.
Let's start there. It's the foundation. Fees are, well, they're the silent killer of your returns. They just chip away at your gains year after year.
I think we all kind of underestimate the impact of small percentages. You see 1% and think that's nothing, but over decades.
It's huge. It's compounding, but working against you. The financial planner Carl Richards had a great quote on this. He said, "Marketing sells dreams, fees wake them up."
I love that. So what are we looking for? It's not just one fee, right?
No, not at all. You have to be a detective.
Okay.
The source material points to 6 distinct types you have to watch out for.
6. Okay, list them out for us.
You've got entry fees when you buy and sometimes exit fees when you sell, which can be a nasty surprise.
Right.
Then the recurring ones, management fees for running the fund, custody fees just for holding the assets, and then, believe it or not, sometimes inactivity fees.
You get charged for not trading.
Yep. And finally, your basic order fees for the transaction itself. You have to add all 6 of those up to get the real picture.
That is way more comprehensive than what you see on the front of a brochure.
Yeah.
Okay, let's move to L, liquidity.
Right. Liquidity is all about speed. How quickly can you sell your asset and get your cash back? It's about your financial agility.
Because life happens, right? You might need that money sooner than you planned.
Exactly. And the range here is just massive.
So what are the 2 extremes we should be thinking about?
Well, on one end, you have things like major stock ETFs. You sell on a Monday, and often the cash is in your account settled by Wednesday. We're talking 48 hours.
Okay, very fast.
But on the other extreme, think about investing directly in, say, a building. Physical real estate, you're not talking about days or weeks. It could be months.
Or even
several years to fully liquidate and get your capital back. And if your personal situation doesn't align with that timeline, it's a huge problem. That clarity is. Wow, it's a critical filter right there. Okay, that brings us to I, imposition or taxation.
This is where a lot of what looks like a great return can just evaporate.
I'll take a guess here. It's because the gross number isn't the number that actually lands in your bank account, right?
Precisely. The government gets its cut. And that fundamentally separates a good gross return from what might be a pretty poor net return.
All the marketing focuses on that big, shiny, gross number.
Of course it does. But if that investment is taxed heavily and immediately, that shiny number gets dull really fast. You have to always focus on what you actually get to keep, the net figure.
So we've got the foundations, fees, liquidity, taxation. Now for the 2 R's, which I feel are what most people jump to first. Let's start with the first R, return.
Return is simply the potential for gain. It's what you hope to make over time.
It's a carrot on the stick.
It is. But, and this is the key, nothing is ever guaranteed. And the only way to measure that return properly is after you subtract the F for fees and the I for taxes.
Ah, so it all connects. The net return is the only one that counts.
It's the only one. A 10% return sounds great, but if 3% goes to fees and then 30% of what's left goes to taxes, well, your real return is a lot lower.
But that raises a question. How can you calculate a net return when, future performance and tax laws can change?
That's a great point. You're right, the final number is a projection, but the structure isn't. You can analyze the fee structure today. You can understand the tax rules for that investment as they exist now.
I see. So you're not predicting the future, you're evaluating the existing constraints on that future.
Exactly. You're assessing the hurdles. If 2 investments have the same potential, the one with the lower hurdles, lower fees, better tax treatment, is just structurally superior.
That makes a lot more sense. Okay, that brings us to the final R, the necessary evil, risk.
Yes. And risk in this framework is just your willingness to accept that your starting capital might go down. It's the fundamental trade-off. There is no return without taking on some risk.
And this part is deeply personal, right?
Completely.
Yeah.
You have to set your own limits. If an asset class historically drops, say, 30% in a bad year, you have to ask yourself honestly, if I saw my account down 30%, would I panic and sell?
And if the answer is yes, then that investment is probably outside your risk tolerance, no matter what the potential return is.
That's it. It's not just about the numbers on a chart. It's about your own psychology,
Yeah.
your reaction to those numbers.
So there it is, the whole grid. Fees, liquidity, taxation, return, and risk. It just forces you to be disciplined.
It does. It stops you from getting seduced by just one part of the story, usually the return, and forces you to look at the whole picture.
All right, this is the perfect time to put it into practice. Let's apply the FLIRR framework to a few common types of ETFs. And, we should say this is a generalized look. Specific funds can always be different.
Of course. Let's start with the most common one, stock ETFs. Think of a fund that tracks the MSCI World or the NASDAQ.
How does that stack up against FLIRR?
It's generally pretty strong. Fees are usually very low, often the lowest you can find. Liquidity is very high, that 48-hour settlement we talked about.
Okay.
Return potential is high, but so is the risk. The market is volatile. But the key here is taxation.
How so?
Stock ETFs are often eligible for tax-advantaged accounts, like a PEA in France or a 401k or IRA in the US. That means taxes are deferred or reduced, which is a massive boost to your net return.
So high risk, high return, but in a very tax-efficient package.
Got it.
Now, what about the opposite end of the spectrum, bond ETFs?
Bond ETFs are pretty much the inverse. Fees are low, liquidity is still high. But the return is low to moderate, and so the risk is also low to moderate.
So they're for stability, not for massive growth.
Exactly. Their main job is to reserve capital and smooth out the ride. They usually have the same tax advantages as stocks, but the goals are just completely different.
Okay, the trade-off is clear there. Now let's get into some asset classes where things get a bit more complicated. Let's talk commodity ETFs, like, say, gold or oil.
Right. Here's where the LIRR framework really shows its power. For physical commodity ETFs, fees are still pretty low, but the other criteria really start to shift.
I'm guessing risk is high.
Risk is high to very high. These are speculative assets. Return potential is also high to very high. But the big red flag comes from taxation.
Oh. They're not eligible for those tax-advantaged accounts.
For the most part, no. They're often excluded, which means you're almost always holding them in a standard brokerage account subject to a flat, immediate tax on any gains.
So that potential for high returns gets a haircut from taxes right away.
A significant one. It fundamentally changes the risk-reward calculation. You have to ask if it's still worth it after you account for that tax drag.
And that leads perfectly into the final category, which takes all of this to the extreme. Crypto ETF.
Yes, this is FLIRR in high definition. Fees are moderate to high because the custody is complex. Return potential is historically very high, but the risk is also very high.
Off the charts, some would say.
Between the price swings and the regulatory uncertainty, yes. And just like commodities, they are almost universally excluded from tax-advantaged plans.
So you've got this combination of high fees, very high risk, and unfavorable tax treatment.
Exactly. The framework forces you to see that whole package. The assets that promise the moon often come with the highest costs and the biggest risks, both from the market and the taxman.
It's just a clean way of seeing the trade-offs you have to make.
That's the whole point. There's no single best investment. There's only the one that best fits your goals, your timeline, and your personal rules. Are you willing to take on very high risk and bad tax rules for a shot at very high returns? Or do you prefer stability?
A conscious choice. That's the goal.
It is. And you have to do the work yourself. I'm reminded of what Charlie Munger said. Take ideas where you find them, but use your own brain to assemble them.
A perfect way to put it. We're giving you a structure, but you have to apply your own critical thinking. Hopefully, this FLIR framework gives you that structure to ask the right questions and continue your own research with a bit more confidence.
And remember, always keep learning. And if you're making a big decision, talking to a certified professional who knows your specific situation is always a smart move.
Thank you so much for joining us on this deep dive. If this content has inspired you to move toward that idea of, buying back your own freedom through smart investing, please drop the word freedom in the comments below.
And please don't forget to like this deep dive and subscribe to the channel. It really helps us out, and you won't miss our next analysis. We'll see you next time.